thoughts on all of that. Stan Shamu joining us now from Melbourne, IG market strategist, of course. Stan, good to see you there. What do you think? Is it a bit of a case of calm before the storm?
Morning, Brady. Absolutely, it certainly seems to be that way. We've got disjointed moves across the board, and of course with that FOMC meeting coming up, I think there's just a lack of commitment to fresh positions as some investors continue to sort of taper off on what they've already got on the table. Now, of course, there's still a little bit of confusion as to exactly what to expect, but the general consensus is that we will get some sort of tapering. Whether it's 10 billion or 15 billion is still debatable and yet to be seen. But most importantly will be the composition of the tapering, whether or not it's strictly just US Treasuries or whether there will be a component of mortgage-backed securities as well. But of course, it does seem like it's consensus among Fed members that this quantitative easing program is getting quite expensive and has lost its luster, so to speak, in terms of being as effective as it was when it first started. So we certainly can expect some sort of tapering tomorrow. But of course, we still need to hear a bit more on the forward guidance, a bit more clarity on whether or not this threshold for unemployment at 6.5% will have to coincide with an inflation of 2% for it to be effective. And of course, the impact this would have on the future of the Fed funds rate. So it will be a very, very important speech by Ben Bernanke at 4:30 a.m. tomorrow. And of course, this is probably going to cause quite a big reaction in some of the major asset classes, starting with US Treasuries and of course the US dollar. And then this will extend to other asset classes such as gold and the rest of the commodities space, along with equities, of course. So it will be absolutely crucial to just find out what this means for markets tomorrow. And this will probably have a bit of an impact on volatility heading into the end of the week.
Yeah, absolutely. Just in the Aussie dollar, I mean, it seems to be sort of around, staying around that 93.5 US cent mark. Did we see much reaction really to the RBA minutes? What can we expect for the rest of the week?
Yeah, I think everyone was looking out for that change in the previous statement after the decision about the scope to ease, and I think the fact that they did say that a rate cut's not imminent made all the difference really, but they did re-emphasize that they will be happy to continue with their easing cycle should conditions not improve or should conditions deteriorate further. So initially we did see a little bit of a dip in the Aussie dollar to around that 92.8 level, but it swiftly recovered as investors realized that it was just another neutral sort of set of minutes. And of course, it does look like they are happy to wait and see how things go for a while. So definitely, I think a lot of analysts are coming out of that November cut expectation and pushing it further forward. Of course, we will continue having to monitor data coming out of the Australian economy and how it's looking heading into next year, and whether or not we can start seeing some improvement in some of these interest rate sensitive sectors after the recent the recent round of cuts. So there is still a long way to go for the Aussie dollar, but for now we actually feel that there won't be too much volatility on the Aussie dollar side of things as opposed to the US dollar side of the equation. As a result, we're likely to hold this range between 93 and 94 cents heading into the Fed meeting. Of course, we do have China property prices due out today as well at 11:30. That's for August, and that might have a bit of volatility for China and of course for the Aussie dollar, considering that China is closed on Thursday and Friday as well. There might be a lot of price movements heading into this holiday. So that's one thing to look out for today. We also have RBA Assistant Governor Malcolm Eddy on the wires today. He might make further comments about this wait and see approach by the RBA and exactly what matrix they will be looking out for before making their next decision on rates. And of course, with the Aussie dollar just looking like it's in that period of consolidation, I think a lot of the traders will remain on the sidelines until they see a new trend forming. Perhaps selling it into higher levels might be a safer strategy for now, but certainly it does look like it's in a consolidation phase.
Finally, what's your opening call for the ASX 200 today?
Yeah, following those slight gains we actually saw in equities, despite the rest of the asset classes looking relatively subdued, we are actually looking at a slight gain for the Australian market, up 0.2% at the open, pushing into that 52.60 level. So that's slightly ahead of that recent closing high that we saw in the 52.50 level. So slightly positive, but very concerning are some of the drops we saw in key commodities like iron ore and gold for the local market. This will probably weigh on some of the resource names, and of course when the resource names underperform here, generally we do see some accelerated selling across the rest of the market. So hopefully we will be able to hold on to these small gains at the open, but look out for the likes of BHP and Newcrest for some drops at the open. BHP's ADR is pointing down about 0.2% at the moment, so we do expect similar losses across the rest of the iron ore names. And of course, with gold testing some key support levels down to that 1,310, there is a real risk that should this FOMC meeting not play out in a positive way for gold, we could see a pretty big drop below that 1,300 level, and this would see losses extending after having held for the past week. So that will put some of these gold names firmly in focus going forward. NAB's just gotten a bit of an upgrade from Bank of America Merrill Lynch to a buy from an underperform, so that might be a bit of a positive for its stock today, along with other defensive and sort of yield plays. But yeah, no, it's all about the FOMC at the moment, and exactly what this will mean for the rest of the globe and how different asset classes will react to it.
Stan, thank you so much for that.
Cheers, Brady.